Well, welcome to another Rogers Capital Market Commentary, where we attempt to be the antidote to water cooler wisdom. Well, first of all, scene change. Thought we'd change things up a little bit at the office this time, and a couple of interesting things maybe in future months I'll point out to you. Some interesting stock certificates I've accumulated over the years, and then the Wall Street Journal from my first day in this business in February of '98. But for starters, fall is here. It's cooling off. Halloween right around the corner, I guess, so get to work on your costumes, your kids' costumes, grandkids, and so well, let's get to it. September. Wow. Could have done without it. Another brutal month, down 9% last month on the S&P 500, putting us at a year-to-date of negative 26. So 30 days of silly season left to go to before the midterm elections. The signals that we've been gauging for a bear market low have not quite triggered just yet, even with all this recent volatility. The VIX indicators have not yet triggered. The put-call ratio has not quite triggered. The velocity of trading, the trend, the TRIN, hasn't quite kicked in. In fact, that indicator being slightly overbought this past month instead of massively oversold. Then finally, the S&P 500, the percentage of that index above its 200-day moving average, it broke above 20%. But of the four, that's kind of the least indicative of the four we're hoping for. Why would we bring these up? Why do we watch these? Well, because it's fairly unusual that a lasting low, a true bottom of the market, occurs until you've flushed all the sellers out. So we'll continue to keep an eye on those. So what's driving all of this? Well, the same couple of things that have been driving this all along. Inflation and the Fed's reaction to inflation, how aggressively they raise the Fed funds. You say, Corey, you're sounding like a broken record. Yeah, tell me about it. Tell me about it. The inability for us to get our arms around inflation, to get much relief in that, and then the Fed's response to just this past month, their insistence that we stamp this out, and insisting on higher rates, even the pain that comes with that, make the market pessimistic that we're going to end up with a soft landing, and that maybe we end up with something a little more severe. So yeah, trust me, I get more tired of sounding like a broken record than you do of hearing me sound like a broken record. But truly, until something changes on those two fronts, it's going to look and feel like it has. So now, the long-term investor, the serious investor, has a different perspective. The S&P historically, we can go back to 1950, so 72 years of market performance. Historically, the larger the drawdown, the stronger the average performance over the next year. In fact, a 15% drawdown has seen an 8% rebound in the next 12 months. A 15 to 20% drawdown has seen a 10.7% rebound in the next 12 months. And a bear market, so 20% or more drawdown, has seen a 17.6% return over the next 12 months. Now, another little thing I'll touch on, you're beginning to hear the term stagflation more and more. Some of you who've been around a little longer have heard that term in the 70s and early 80s. What is stagflation? Well, stagflation is a period of very low growth and rampant inflation, so high inflation. You say, that sounds like today. Well, yeah, I mean, technically, that's what we're dealing with right now is low growth and rampant inflation. But to look back and compare this to the mid 70s, late 70s, honestly, the whole decade of the 70s, and then the early 80s isn't quite honest, quite accurate. In the 1970s and 80s, you had 13% unemployment versus 3% today. Interest rates, Fed funds rates, 20% Fed funds in 1982 versus 3% today. Inflation, yes, a little bit out of hand here, but in the 70s and 80s, 13% inflation versus 8%, where we are today. So some notable differences. Really, I understand the concern. You know, the 70s was a disaster of a decade for the markets, for investors. But some differences between then and today. Even when you hear this stagflation term bantied about, you don't see unemployment today like we did back then. Fed funds interest rates are not anywhere near where they were in the 70s and 80s. And yes, inflation, not great, but still not quite where we were in the 70s and 80s. It's a little different today. Things to watch. That's it for this time. Look forward to talking to you next month. Have a great October.